Okay.
Okay, want to go ahead and kick us off then, Ken? We'll get started.
Well, yes, we'd like to welcome you to this presentation sponsored by the Mid-Michigan chapter of Better Investing. This is the roundtable, and essentially it's just four guys, all with better investing backgrounds. We have Mark Robertson from Manifest Investing, and Mark is the former editor of Better Investing magazine. We have Cy Lynch, a former director with the Atlanta chapter and a former member of the NIA board. We have Hugh McManus, a former president of the NIA board, and myself, I'm the current chairman of the BIVA board and a director with the Mid-Michigan chapter. So I'm going to turn it over to Mark. He has some scorecards, and he's going to explain these strange pictures on the front here because it looks like I'm wearing a muskrat. I don't know.
It does kind of look like a muskrat,
Yeah,
and that probably gets Cy Lynch all fired up. But good morning, everybody, and happy Halloween, which is the explanation for the costumes here today. That is not a muskrat on Ken's head. That happens to be Maria Bartiromo's hair and jewelry, her bling, so to speak. And for those of you that have seen educational presentations by Ken Kabula during the part where he's cautioning us not to take any one media person too seriously, he often pretends to flip his hair as if he were Maria Bartiromo. So I just thought, actually, that image is a little tough to take, but we'll try to live with it. For Cy, we basically threw in the Tasmanian Devil. He had a wonderful year for the Atlanta Braves, but that probably best captures his spirit these days. And our leprechaun joining us from Pasadena, near Pasadena, California, Hugh McManus, and his pot of gold. He's going to get us going with the big picture here in a few minutes. And for no particular reason at all, we just threw an Oscar the Grouch costume on me. I did have a nickname of Oscar as a high school basketball player, so it somewhat fits, but just thought that might be kind of some fun. Here's the agenda for today. I'll kick us off with a few comments. We'll take a look at how we're doing. We'll go into a big picture commentary from Hugh. He wants to talk about confidence. There are no challenges, so we can cross that one out this morning. None of the four of us have decided yet to challenge any of the selections that have been made since July. And then you'll see we'll each go into our four stocks, and we'll try to leave a little bit of time. We do have a full agenda here today, but we'll try to leave a little bit of time for Q&A at the end. We will stick around as long as you guys have questions. Let's go ahead and take a look. There's our reminder to keep the lawyers happy. I'm just going to say this is not an investment recommendation of any kind. We do this for educational purposes. I hope you guys all know that. And just again, as Ken said, what this demonstration is basically the four of us coming together once a month to try to identify a stock with high potential. And we make no bones about it. We are attempting to outperform the market by 5 percentage points long term. We will tolerate non-core selections as long as they don't overpower the portfolio, because we all know that every once in a while you can really do extremely well with, let's just say, less traditional stock. But we will benchmark against the Wilshire 5000 and hope to perform well over the long term. Here's a look at the selections that have been made since July. They're actually ranked by the size of the holding. We put $1,000 into them on the day of selection, so the stocks that we picked today will be added to this dashboard as one of our scorecards. And you can see that our best performing selection is Walgreen. I'll just give a gentle nudge to the Challenge Club that voted that one down. Not that I would ever say I told you so. But I also selected Strayer, and you notice that Strayer's hasn't performed extremely well over the last month, but it did perform extremely well yesterday and everything in between. Here's another look at the scorecard in the method where we actually try to keep track of how well our selections have done since the time of selection versus the Wilshire 5000. And you can see that the market returns would be the returns during the same holding period for the Wilshire 5000. You can see that we're struggling a little bit, but it's really out of the box. For those of you that were here 3 or 4 months ago, Cy Lynch talked about how he's witnessed over the years that many times it takes time for the selections made by NEIC or Better Investing based investors to to germinate, and takes a little bit of time. And I've seen that also in my experiences with investment clubs and with some of my stuff over the years. It just seems like every once in a while you just have to give them some time, and we certainly will do that. But you can see that we are not yet achieving our target of outperforming the market, but we intend to. Those are some pretty good companies that have been listed so far.
Just one quick thing on that, Mark,
Yeah,
too. Um, I noticed both with the portfolio of stocks for my Better Investing magazine features, and I believe may have noticed it somewhat with our mutual fund picks at Manifest as well.
Okay. Okay.
That both of those portfolios started in mid to later phases of the bull market and actually trailed the market for a while in the bull, but really started pulling ahead once the bear turned.
Mm-hmm.
So that and this portfolio is similarly starting in a mid or so bull market.
Yeah, at least during the surge, you can see that we're up 11% since the end of August with some of those.
Right.
So yeah. So absolutely, I do think that that our method does tend to shine a little bit better. It shines all the time, but I think it shines a little bit better during bear markets. So you're right. That doesn't mean we sit around hoping for bear markets, but I think Cy would certainly make the case that what we do is know what to do with them when we get them.
There you go.
So with that, I'm going to turn it over to our friend from California, Hugh, and Hugh wants to talk about confidence this morning. So
Yeah.
Go ahead, Mr. McManus.
So I hope I have no problem with sound, right?
Let's hope not. Knock on something.
Good. Yeah, it's a fun every time logging in. But yeah, I mean this Great Recession, as it's called, and it's a really appropriate term, is scaring the jeepers out of a lot of people. Fortunately, all the signs are it's coming to an end, and that's a good thing. But the fact is that this recession is kind of different. I mean, I hate that term when people say it's different that time. We heard it all the time in the 90s with dot-com stocks, and we heard it with when the mortgage bubble was in its heyday. But this one really is different, I think, than anyone that's online has seen in their lifetime, and it really harkens back to what happened with the Great Depression, because this is a recession where balance sheets have to be repaired, both on the business side and on the consumer side. And the fact is that that takes time. And then the other thing that I always tell people, and this is supposed to be optimistic, even though people will look at me a little bit squirrely when I say it, it's kind of amazing to me that this is the first quote-unquote near hit with a depression that we've had in almost 80 years. Because if you look back at history, recessions and depressions were incredibly common. Panics, and this is as close to a panic as we've seen since, I guess, the 1930s, happened probably every 15 years in the late 1800s into the early 1900s. There was a very big one in 1905 that really mirrors what we've seen recently, and there's a very good book on the topic. Mark and I read it just before this happened in 2008, and it was almost like a playbook to some extent. But the big thing is,
we're both rich now.
Yeah, really. But the interesting thing is, even if you go back to the Great Recession and the Great Depression in the 1930s, and you look at the history of recessions after World War I, so from 1918 to 1930, there were 4 or 5 of them. No one ever talks about that. The fact that in 1923, the Dow lost about 25% of its value, and the economy shrank by, I think, almost 20%. And this happened regularly. It shrank by 23% in 1920, and it shrank by, I think, 10 or 12% in 1926. These were very, very common, so definitely brakes have been put in place to slow it down. But it took 80 years for it to happen, and it did happen in 2008 and beyond, and it's extremely painful. And by virtue of the fact that I think we don't have experience with really severe downturns, people are doing what people do, and companies are doing what they're acting conservatively. They're husbanding the resources, and they're paying down debt, so they're in a much better position to survive in the future. They're looking at the future, and I guess all of us see uncertainty, and naturally enough, we see a little bit of pessimism, because almost by definition, there's no downside to being pessimistic, you know? So that's the big problem, is the fact that everyone is husbanding their resources and saving things and taking less risk. And I'll demonstrate in a minute that the Federal Reserve has phenomenal resources that you can look at these things from a macro level, but you can see charts that demonstrate clearly that spending is down, credit is problematic, and savings are up. So let's move on to the next slide. And I'll actually skip to the one after this because it shows consumer confidence from both the Conference Board, which is in blue, and the University of Michigan Consumer Sentiment, which they tick every month, and that one's in green. And you can see that this goes from January 2000 on. And confidence was super high at the end of the dot-com bubble over on the left-hand side, as you see. And then for most of the life of the last decade, it was around the 100 mark, and that's about normal. But it took a nosedive in late 2007. A lot of us saw that happening, but again, it takes dives periodically, and you don't really pay too much attention. But it kept dropping, and consumer confidence reached a record low, and it is now actually in a record low range, and it continues to be there. And I've provided on the bottom, you can see there's sources for these. This is from a Forest Advice. And in business confidence, this is a different way of measuring confidence, but this is in business, and we can see better numbers for this as well. But you can see that that is low as well. It's normally much above zero. It's normally much higher, but it's low, and it remains low. So let's go to number 11. So
Hugh, this is Ken Hugh. While you're changing slides, Diane Ellison would like to know what's the name of the book that you were referring to that you and Mark read?
There's one book called The Panic of 1905, which is a really good read. And then there's another one which, wow, this one was super scary, called The $1 Trillion Meltdown. And I believe it has been revised, right, Mark?
It has been revised, and the numbers were enlarged.
Oh, wow.
And the author of that one is Charles Mackay, M-A-C-K-A-Y.
He's a frequent contributor to the Wall Street Journal. Bit of a curmudgeon, but, you know, ultimately, if you're a pessimist, you have to be right once, I guess. Huh? But his logic was unassailable and quite scary. And then the economy did the experiment and validated what he was saying.
I'll add those references to the post on our forum when we're done.
So as I said earlier, when there's uncertainty, you kind of you stop spending. I mean, if people think they're not going to get food in the future, they'll start to eat less. Just watch Survivor and watch them guard that rice carefully. It's normal human behavior. It's pre-programmed in us for 4.6 billion years. There's nothing really we can do about it. And we can take advantage of it as investors. But spending has declined. Investment has declined, and unemployment is on the rise, but fortunately it seems to have stabilized, and there are signs that it might even be dropping. So let's just move on and see the next few charts that come from, this is from Bloomberg, but we'll show some examples later. This is discretionary spending, so this is basically money that you don't really have to spend. You've coffee at home, but you elect to spend X percent more and buy it at Starbucks, that kind of thing. And it's at an all-time low, and that's bad. Discretionary spending is really what gives the economy that extra oomph. 70% of the economy, the GDP, finds its source in consumer spending, people like you and me. And right now that is at a record low. And if we skip on to the next slide, you can see that it's stable. These numbers come from an organization called Business Insider, but the poll was conducted by Gallup, and it was published in September. And it looks at consumer spending up to 2010, which is the light green. And if you look at the September number, you can see 48. So we'll just look at the numbers and compare them, not really worry what they mean. But you can see that consumer spending in that light green, the discretionary spending in the light green was steady for most of this year and has started to decline slightly. I think we got a bit of a scare in the summer, in August, when the stock market went south again, and we heard panics about banks, etc. But it is lower than it has been in the past. And the number right at the top in the heavy green, and I didn't pick these colors, nor did Mark, but the heavy green shows what it would be if everything was quote-unquote normal. So it's low, and it's significantly lower than a normal period in the cycle of the economy.
that certainly explains how disruptive it is.
Oh yeah, incredibly disruptive. It will pick up. I mean, it's only a matter of time.